up the Chapter 11 handout and hopefully the Chapter 10 handout also. The Chapter 10, 11 exam will be emailed tomorrow. It is the last exam. It'll be due a week from tomorrow. And by the way, that's the last day of the course. So it's the last day to turn in stuff. So if you have stuff to turn in, make sure you get it in by that day, whether it's exams or assignments or whatever. Next week, we will have a meeting, but it'll only be for tutoring and assistance, no new material. No moo material will be assigned. So next week, I will have class. I will have the Zoom meeting, but it's only there for you if you have questions. If you don't have questions or anything like that, there's no need to attend it. So this is tomorrow. You'll have the last thing for the class will be emailed to you guys, and if you want assistance or tutoring or whatever, by all means, tune in next week, and I will be here. Okay. By the way, I had dental work. The side of my face is all swelled up. So if I talk funny, it's not because I'm trying to be silly. Okay, let's go to E11-2. I think we did some of this together. I don't think we did all of it. I don't think we did these. So maybe check those, actually see if I did them right, but also see if you did them right. And if I didn't do them right, please let me know either by saying it or by putting it in chat. Either one is fine. I think those are the right numbers. And I stupidly left my okay, and here's the units production one. I think these are the carry values. And the accumulated depreciation amounts. And again, if I did them wrong, let me know. Yeah, these are book problems. I should just look at them. Okay, I get something quick here. I gotta turn off what I can on this thing. Yeah. Okay. Okay. Any questions on that thing? All right. This leaks a little bit into chapter 10, which is the has to do with kind of other stuff that's to do with depreciation and book value and all that, but did we already do this? We must have. Oh, wait. Okay, I'm sorry. This is a different one. Man, I thought that was the only one we did like that. All right. What is that? 17,500. Did we do this already?
I'm not too sure. I was absent the week before break, so I don't think I did any of this.
Remind me, I can put up the other stuff here. Okay, so let's see, accumulated depreciation is, and this would be what, 97,500. Okay, okay, thank you guys. Yeah, yeah, okay, we did do it. All right. Well, for whatever reason, I didn't fill it in. So, okay, here's these are the carry values. And this one is unusual, not unusual, but it's different in that it was purchased on October 1st, so we only had it for 3 months. So that's why you have this. You take the depreciation. And for 2027 only, we depreciate over 3 months. All the rest of them will be 11,000. Same thing down here, 3 months. Now, units of production is a little bit different in that it automatically adjusts. You'll notice that this one has fewer made because they only used it for 3 months. So units of production will automatically adjust for dates. Let me write that in here. It's not really a sun as well. Oh, units of production. You don't have to worry about days and months for this one because if you have it for fewer days, you're going to make fewer items. It'll automatically adjust for it. So, we only did 10,000 units because we only had it for 3 months. Okay, and that's where we ended, right? Okay. All right. So let's go to any questions on any of this? Let me back up and just make sure that. So I can get screenshots of this. There's one, there's straight line, I should say. There's double declining balance. This one will also be for. And units production, this one will automatically adjust. You don't really need to do anything to it because you'll just make fewer items in that first year. It'll automatically adjust for it. And by the way, the company can use any of these three items. It kind of depends on what they're depreciating. They're not supposed to do this, but a lot of times different industries will have ones that they favor over the other ones. But the AICPA says don't do that, but a lot of them do. And they do it for a reason. A lot of times people in the same industry will do it so that there's a comparability between them. Okay. So let's take a look at E1110. Machinery they purchased at cost 400,000. It was expected to produce 750,000. I don't know why I'm reading this to you. I just gonna read it. And use production method. So this one will automatically adjust for the dates, the interim dates. Depreciation, it isn't, the idea behind it isn't particularly difficult, but it's just kind of it's tedious. So units of production, okay. And this one will automatically adjust for the interim dates. This is the only one that does that, by the way. Okay, so, and you'll see this here, that they made 26,000, no, I'm sorry, in 2026, 2026, they made 160,000. And in 2027, they only made 80, and that's because they sold it about roughly halfway through the year they sold it. So that makes sense that they made about half as many. Okay, so let's see how much it is per unit. I'm going to cheat and look up here and see how I told you guys to do it before. Cost minus, okay, good. I think that's the way the book shows it. So the cost is 400,000. Oops. And residual value is 50,000. And we're going to divide all of that by the total units that we're going to make in the thing's lifetime. Oop. So 700,000 units. They give it to us both in years and in units. Okay, so let's see here. 400,000 minus 50,000 is 350,000. $700,000 is still 700,000. Is this the same thing we did up here? This comes out the same. I should change that. Okay, so, oops. 50 cents per unit? Again? Yeah. Well, I'm doing this on my calculator now. 50 cents per unit. Okay. Yeah, it's actually say, oh, it's 50 cents. Oh, it's 50 cents. Okay, so this is 50. So this is depreciation per unit. Okay, so all we're gonna do is take this 50 cents and multiply it out here. $80,000. Oops. Okay, this one's 80,000. This one's 40,000. I don't like this problem for two reasons now. Oops, 40,000. Actually, because I can't do it. No, but the 80 and the 80, these two are unrelated. The 80,000 units and that, those are unrelated. Okay. Oh, and down here. Okay, so 400,000. And that's going to be the cost for every single year. Okay, so 2025. Apparently probably bought this somewhere in the middle of the year, I'm guessing. Probably early in 2025, just because if you look at the units produced, they're making 160,000 a year. If they were running it at full tilt, it would have been, somewhere in the middle, somewhere in the early part. Okay, so it's 50,000. The depreciation the first year is going to be exactly the same. 1,000. Let's copy it. Security value is 350. All right, second year is what, 80,000? I'm gonna change these in a second. Just to keep the formatting down to a minimum. So was that 130,000? The book value would be 270.
Where did you get the 130,000 from? Like when you subtracted 80,000?
Oh, that for the accumulated, that's just going to be the let me see here. The accumulated is going to keep adding up. So this will have both of those together. This is actually it's a contra asset. Let me put that in here. This is actually what they call a don't do this. This is actually with a contra asset. This will go against the. I don't think I put this up last time. This is a contra asset. This is going to go against the cost.
Thank you.
Yeah, yeah. So these two will go together. And by the way, just so you know, these two are going to be locked together for their entire life until they get rid of it. The accumulated depreciation will be locked in with that asset. They'll both be on the balance sheet together, and then when they finally get rid of them, they'll both come off the balance sheet together. And it's just a kind of a it's there for a reason. The reason that we do it, you might say, well, why don't we just reduce here we have this asset on the books. What was this equipment on the books for 400,000. Well, why don't we just decrease the 400,000? The reason they do that is that this shows the original cost and possibly the replacement cost would probably be somewhere similar to that. So if you're looking at these books and you go, okay, well, it's gonna, we're gonna run out of depreciation pretty soon here. Um, how much is it going to cost to replace it? There's nothing wrong with thinking of it in those terms, though. That this thing is okay. So let's see. What's 170 for 230? I'm glad you asked that because I don't think I put that up there last time. So these two will go together for their entire life. And actually down here, we're going to see about when they sell it. Okay, so this is our carry value for this thing. Let's see that one. 230. Okay, yeah, that's probably pretty close. Okay, so Prison wants you to record the sale of $210. Okay, so here's what we have on our books. So, oops, not safe. So, okay, so one way to kind of look up is, what we are, the value of it. I have it at carry value. I'll say carry value. Carry value and book value are the same things, but let's keep it the same. So carry value is 230,000. And it doesn't matter, where we sold it throughout the year, because this is the units production, it doesn't matter. The dates don't really matter too much. And what we received, okay, so the carry value was 230. What we received in this case, and this is actually a little bit of a shortened version of it, but we received what, 210,000? I'm gonna put one more line in here. We'll say the fair value. The fair value must have been for what we sold it for, right? Do we have a gain or loss on this? We have it in our books for 230. Someone came in, wrote us a check for 210. Do we have a gain or
Would it
loss?
would it be a gain at 20,000 because we still have it left? But like again, I wasn't here the week before, so I'm just taking a stab at it.
No, actually, because this is on our books for more and we're getting less, we're going to lose. This will come in as an asset, and we're going to give up basically a net asset of 230. So this guy should be a loss of. And this actually the way to really kind of calculate it is here. I don't do that. It's the same thing as you. Let's make it green. Oh no, turquoise, turquoise. So we get our books for 230. It's only worth 210, so we're gonna have a loss here. So this will be a loss of 20,000. Oops, dollars. Okay, so let's come down here and see what we're gonna do. First things first, we sold it for 210,000. June 23rd. Shoot. Um, let's take the easy one. How much cash do we get?
210.
210 cash asset. Oops. Asset going up. You don't need to put that in. Okay, and let's see what we gave up. Now, this is equipment, right? Yeah. So this equipment's on our books for 400,000. So we had to take that off. Now it'll be on the books in the debit column for 400,000. That's when we bought it. That's what it was worth. So we got to take it off. So it was a debit. So to get rid of it, we will credit it. Oops. So this is an asset going down. Let me try that again. For 400,000. So we're taking this off the books. We got to take accumulated depreciation off the books for 170. Now this is a contra account, so this would have been recorded as a credit, so we're going to get rid of it with a debit. Yeah. Okay, now these two sides don't add up. What do we need?
Our lost margin.
Yeah, so this will be our loss, and a loss is similar to an expense. It's money going out. So loss is treated the same as an expense. Technically, it's not because we don't. 20,000, right? We're not in the business of whatever this equipment is. We're not in the business of selling that equipment, so it's just going to be a loss. It's not going to be an expense, but the idea is exactly the same. It's money going out. We had our books for 230. We only got 210 for it, so we all lost. And those should all add up. They do. you don't need to put those in. Okay. Any question on this one? Get a picture of it. Screenshot. All this extra space in here. By the way, I realized actually just today that I didn't put the chapter 11 handout in Blackboard. It actually is in there now. I apologize for that. Okay, let's go to E. Oh, this one's a mess. Oh boy. Okay, well, we got some ciphering to do here. On July 1st, now they're going to use the straight line depreciation. Okay, so we do have to worry about the dates on this one. So what we're going to do is figure out how much this is per year, and then we will figure out what the depreciation expense is. All right. So let's see. Well, it's kind of funny down here. We can actually do this. Okay, so paid 126,000 for it. The residual value is 30,000. 8 years. So we will calculate appreciation for that. So the cost is 126 minus the residual value of 30,000. And we're going to divide all that by the life in years. This is the straight line method. By the way, the reason they call it the straight line method seems like kind of an odd name. Well, here, I tell you, I'll show you in a second. Let's go ahead and do this. And I'll show you. Life is 8 years. Wow. Equals. Okay. 126 minus 30,000. 96,000. And divided by the life in 8 years. So this will give us some number. Yeah. 12,000 per year. Oh, that's a nice number. You like seeing numbers like that because if you're doing it by months, things that are divisible by 12 are really highly prized, and 12,000 is divisible by 12. So this is the depreciation per year. Okay, now we have 2 years that are going to be a little bit of a problem for us. That is the first year and the year we sold it. Those are interim date years. We bought it on July 1st. So in 2022, I'm going to call this depreciation. Um, Depreciation date calculations. I should say interim dates calculations, but I will. Okay, so how many months do we have it in 2022?
We have the whole year, right?
We bought it on July 1st. I'm assuming they have a calendar year end.
So 6 full months, half a year.
Yeah. So that's a, oops, I need another zero here. Oops. Okay, so this, I'm gonna put this in parentheses up here. This is 6/12 for half the year, the first year. So we had it for July, August, September, November, October, December, October, November, December. All right. Now the next interim date we have is March 1st. So we had it up through March 1st. How many months did we have it in 2027?
Would it just be three because it was sold on March
Yeah,
1st?
it's actually going to be
Or
two.
would it just be two? Yeah,
Yeah,
yeah.
yeah, yeah. But yeah, we only had it for the first part. We didn't have it after that. So, one of these is what's left in the year, and this one is what is. Oop. So this is 2027, 2/12. I think I told you guys this, when I took the CPA exam, they didn't let us use calculators. You couldn't use calculators. So in some ways it was kind of difficult, but in other ways it was kind of easy because almost all the numbers came out like this. They didn't have you, and so you knew if you got some strange number like 527.382, you knew that you did it wrong. Okay, so now let's go ahead and put this in here. So I'm gonna put this in. So over here, let's put this as 6/12. Oh wait, no, I'm sorry. I put the dates in here. This was July 1st, I'm sorry. Okay, so let's take a look here. So asset at cost, 126. Oops. After working on this computer for since COVID 4 or 5 years ago, I realized I need a little light so I can see the keyboard. And this can be the same for all these. So you sit there at 126. And again, that is kept around so that people know that when you are replacing it, ballpark what you're going to be spending. Okay, depreciation expense. Now, for every year, it's going to be 12,000, except for the first year, it's 6,000. We're going to put those in first. The last year is 2,000. All the rest of these are going to be 12,000. Oh, I didn't tell you why it's called the straight line. Well, actually, here let me put these in, and I'll talk about it. They call it the straight line because if you were to chart out the carry value of this, it'll go in a straight line. Every year it'll go down by 12,000. So it's called straight line because of the carry value. Every year it goes down by 12,000, and if you chart that out, it's a straight line. It should probably call something different, like by the years or something. But anyway, that's the name of it. All right, so now this is a somewhat tedious part. Although if you just needed the carry value at the end, you could just add all these up. This would be the accumulated depreciation. Want to do that? Let's do that.
Will we be able to do that for the test?
Yeah.
Okay.
Well, yeah, for these, yeah. I'm gonna for some of these other ones, like I'll say give me the first 2 years of the following. By the way, I never have you do all of them. I'm not gonna have you do 20 years or something like that. But for the exam, yeah, you can do that.
Thank you.
And when you look at if you look at the CPA exam, they'll ask you questions like, what will be the accumulated depreciation in 2024? So you gotta be a little bit careful in that you need to know how to get those. But if we're just doing this, this is for the sale of it. Okay, let's see here. How many 12,000s do we have? 4. 56,000? You guys got?
Yes.
All right. All right. So we can actually, if we jump ahead, this will be 56,000. So the carry value would be 126 minus 56. Oh, this should be a nice number. What is it? 70? Check that. I think it's 70.
That's what I got.
Okay. Okay, let's see here. Oh, prepare the journal to update the depreciation. Okay, so this depreciation apparently has not been updated. Maybe they do it at the end of the year, but they sell this thing on March 1st. They still need 2 months of depreciation, so they have to update the depreciation. So we'll come down here. Now remember my morbid way of remembering this. At the end of its life, it's dead. DE. AD. And that stands for depreciation expense. And this stands for accumulated depreciation. Ag. Oh, no, don't do that. Okay, so that's what, 2,000. So we're updating it for last year. Oops. And again, this is this is for all of them. So I know it's morbid, but dead alive. Okay. Okay, now I don't like this problem. I realize it's doing something I don't like. When I saw the 12,000, I loved it, but now it's got something confusing going on. Okay, they sold the truck for 56,000, 56,000.
No, they sold it for 58.
Oh, that's right. Yes, D8. Thank you. The carry value was 70. See, these are tedious. They're not. Now, the fair value in this case must have been what we sold it for. This is why I don't like this problem. Do we have a gain or loss? We have it on books for 70. We sold it for 58.
We lost 12,000.
Yeah. And this is why I don't like this one. I loved it up until this point. Um, this 12,000 is not related to these 12,000s. That's an unhappy coincidence. So, if you're looking at for why we got this 12,000, we got this 12,000 because the carry value and the fair value are different. If the fair value is less, we're going to have a loss. Okay, so what would the journal entry be? Let's start with the easy one. How much cash do we get?
58,000.
We got to take off this asset at cost. So this would be, these would be on the books as debits, so we got to get rid of them with credits. What was this thing anyways? Truck. They could record it as a truck or equipment. I'll put it as equipment. Could be. Hey, what am I doing here? What? Am what? We gotta take the accumulated depreciation off. $56,000. That would be debited. Yeah, originally it was a credit balance, so it would reduce the equipment, but now it's gonna be debited to come off. $56,000. I'm gonna do something here. So we are out of balance by what, the 12,000? And that would be similar to an expense. This is where the loss would go. So it's increasing a loss. 12,000. Actually, you don't put the dollar amounts in those. So assume they're dollar amounts. Okay, yeah, so that's it. And these should all both add up to 126. They do. You don't have to do this. Okay, let's take a break. We'll say be back at oh no, 304. Oh, just changed 305. Okay. Sorry I'm late. Let's see. Let's go to the next handout. The next handout is chapter 10, and we'll see what we get through out of here. I had to give my dogs their lunch, and the one dog has medicine in hers, but the other dog didn't eat. So, and you can't let the little dog will bully the big dog. And so it's a long story. Okay. Trade-ins are a little bit tricky. Okay, so let's take a look here and see. So I'm gonna copy from this one. And by the way, I wouldn't even care if the little one ate the big one's food, except that she throws up. Then she throws up her medicine, and they both didn't get lunch. And it's funny. You go through college, you get okay. We're gonna, you guys are going through, and you go, okay, I did all this. I, live my life right, and you sit there waiting for little dogs to eat food. Okay, so the book value was 180,000. So book value and carry value are the same. I should probably put that in here. Uh-oh, what happened? Okay. Book value, carry value are the same thing. So we traded this in. It's a trade-in. Traded an old one for a new one. Okay, probably pretty common. Okay, so the carry value or book value on the old one was 180,000. And the fair value was 200,000. Okay. Now they don't tell us what the fair value received is, but probably because they're supposed to add this up and figure out what it is. Cedric paid $60,000 to complete the exchange. So let's see what let's see what they got. The dealer got. So the dealer got equipment, whatever it was, for 200,000 that was valued at 200,000. And then they got another 60,000 we paid on top of it. So, oops. So what we received was equipment valued at 260,000. By the way, we have a gain or loss on this trade-in.
It would be a gain, right?
Would it be would it be a gain of 20,000?
Yep, would be. Oops, yeah, this is. Yeah, they gave us a credit of 200,000 basically on it, and so this is what we got in. So we got equipment valued at. Tell us a date here. They don't tell us a date. Yeah, don't need a date. We'll just put a big question mark there. Okay. I gotta redo these. These should be left justified. Okay, so I'm gonna put in that we got this is equipment, right? Equipment. Now we gotta keep track of which is which. So this is what we received. We have equipment. I'm gonna say new. $260,000. So this is the new equipment. Now we got to take off the old equipment. So how are we going to do that? Give me a hint. We just did it in the previous problem. Original
Can you
cost.
repeat the question?
One more time.
Can you repeat the question one more time? Sorry.
Yeah, what would be the journal entry for this? We got to take off the old equipment. It's similar to this. It's similar to taking out here. Notice that on this one, instead of us getting cash, we're going to give cash. We'll do that in a minute here. But we take off the old equipment. It looks like that. You kind of reverse out the accumulated and the equipment itself. So let's see here. So the old equipment's got to come off the books. Will that be a debit or a credit?
Credit, right?
Yep. That was for 400,000. And we also gotta take off the accumulated depreciation. Uh, 220. Okay, we still need two more things.
We need the 200,000 and then the gain, right, of 20,000.
All right, so we need the gain of 20,000. So a gain is sort of like a revenue. Is money coming in? So the gain will be a credit. So let's put that on. Oops. 20,000. And there's one more thing we need. We're gonna add up both sides right now. This one will be at 480.
Yeah, we need the 60,000.
Yep. So we paid out 60,000 again. So this is cash Asset going down. Yeah, that will make these both 480. Okay.
Would that just be a cash payment? That that last 60,000?
Yep.
Oh yeah, yeah.
Yep. So cash going down. So we gave up, uh, book value wise, if you want to take a book value wise, we gave $180,000 book and $60,000 cash to get a $260,000 piece of equipment. Okay, same as 14, except the fair value is 170. Okay, so copy this down. Probably run out of room down here, I'm guessing. So the difference is that this fair value was 170. Okay, so how does this change? Oh, I didn't say that was a gain. I'm sorry, let me put that in. This is a gain. Do we have a gain or loss here?
Well, I lost the 10,000 now.
Yep. And notice that the equipment we got now is going to be something. What are the 230? Yeah, 30, yeah, 30, so this is $230,000 piece of equipment. State is still unknown. All right. Justify. I thought I had this one worked out. But anyway, let's go to, so new equipment. It's all gonna be the same with the exception of, well, and the new equipment will be on the books for less. Okay. Well, let's put them in here and see what they were. Okay. So we get new equipment. And the value is, so the asset going up. And the value is 230,000. And we have to take off things up here. The original cost is still 400,000 and 220,000. I'm gonna copy. It'll save us like 10 minutes. Let's copy. Okay, so we put the new equipment on the books. We took off the old. What else do we still need?
The cash payment still, the 60,000, right? Stays the same.
Mhm. Oops. Double loops, they should be moving that over. You don't have to do that. Cash is going down by 60,000. And one last thing.
No loss margin of 10,000.
Yep. And a loss is sort of like an expense. And the expenses go up with a debit. So we have more losses now. And whenever I do calculations like this, I like to add them up just to make sure. And that is the beauty of, I know it's like a kind of a pain doing journal entries, but one of the beauties of it is you can see right away if you did something wrong. Or I shouldn't say that. If you can see right away, if your debits and credits don't add up, you know you did something. It's possible to have your debits equal your credits and still do something wrong, but if they don't add up, then you really know. Question on that one? All right. Let's go to the last page of the course. This is the one we were looking for all along. The last page. Okay, this one is very similar to what we just did. You know what? We can't do the journal entry for it though. Why can't we do the journal entry for this one? I adapted this one. I should have put it on there. We can't do the journal entry. I know you guys are heartbroken, but we can't do the journal entry for this one. Why? They give us the book value, but what don't they give us?
The depreciation over time?
Yeah, we don't know what they paid for it and how much of it is.
We don't even know like the exchange, right?
Yeah, well, we do know that it had a book value, but what we gave them it had a value of 150,000. We can actually figure out the gain on it, and we can also figure out the value of the equipment because we gave them paid the owner of the equipment 10,000. Okay, so actually we can do some of this here. Okay, so we had the carry value of 120. Book value they saved 120, same thing as carry value. The fair value is 50. And so what we got, it was $150,000 piece of equipment. Oops, that's not right. Plus we paid 10,000 for it. So we really gave up, the fair value of the equipment, 150,000 plus the 10,000. So what's the fair value of the equipment? 160. And again, we can ignore the journal entries that can't be done. So skip This is an error on my part of information. Yeah, so carry value or book value, same thing. You know what for taxes, they call this the basis. Oops.
Professor, I have a question real quick.
Yeah,
So like like for a problem like this, like if the value, like the appreciation or depreciation value was like wrong, is this how you pretty much like find out if a company is committing like tax fraud or not? Like with the Bronco Corporation, like because if it was a different value, like none of this stuff would equal up, and then you could easily tell that they're committing like a tax fraud or something, right? Because like the money's not all adding up.
actually, the tax code they actually give you the tables to use. You have to use their tables. You can't just use your own. The tax code does not allow for you to use your own. And the tax code is usually pretty generous to people, and that it allows for depreciation of things very quickly. For instance, you have a piece of equipment, maybe it's going to last for 8 years. They may let you depreciate it over 3. And that means your depreciation expenses go way up in the early years. So you get, they want to encourage you to buy equipment. They want, it's good for the economy. It has nothing to do with the book value or the fair value either of it. Um,
What would be the benefits of that then? Like if a company was or like if they were giving you 3 years to depreciate, you'd be able to keep more of the profit towards the end of the year that you make, right?
exactly. You get to write off more.
Because because of the pre depreciation is such like a bigger expense, I guess then, right?
Yep.
That you would get to keep more of the money that you made.
Yeah, I bought a 3 flat in Wicker Park. This was years ago. I don't know how many years ago it was. But anyway, yeah, probably like 25 years ago. Anyway, when I bought it though, you go through the place and you go, okay, well, there's refrigerator in there and there's a stove and there's all this stuff, there's washers, dryers. And so you kind of get a ballpark figure for what those are and you put those on your taxes. And the first year I had a loss of $11,000 on the building. Yay! Because that's like, I don't know, like $3,000 or $4,000 of basically of cash. And think about depreciation. There is no, there's no cash involved. So when you hear about paper losses, let's go up.
Does the percent of depreciation also like determine like if it's like a car or like a plot of land or like something like that? Will the depreciation value be different?
Yes, yes, they have different categories of where it goes. Whether it's they and like with automobiles, they'll have something for different pieces of equipment. They'll have, and you look into the details of it, and they'll tell you which one that you need to use. Um, but yeah, and again, look at that depreciation expense journal entry. Let me go back to we did it earlier. Here's you guys can't see what I'm doing. I apologize. I do that every class. It's consistent. So here's the journal entry for it. This is the standard journal entry for depreciation. Notice there's no cash in there. It's a paper loss. So here's the great thing about depreciation for taxes is that you get to have this expense that lowers your taxes, but you actually didn't pay anything for it. There's
So
no
would you get all 2,000 of that back though? If you were like a big like if you were in a company?
No,
and do it.
it reduces your income by 2,000. So whatever tax rate you are. So let's say if you're at the, I don't know, I'm just making this up, 25% tax rate, this would mean that you get back what, $500? There is a thing called a tax credit. Oops, yeah, not 5,000, 500. There's a thing called a tax credit. Now, a tax credit will be dollar for dollar, but for something like depreciation, it'll reduce your income by 2,000. So if you're paying 25% taxes, if this is a tax rate, so if your tax rate is 25%, you'll basically be given, you'll the cash amount that you'll either reduce your taxes by or get a refund for is $500. And again, remember, there's no cash in here. You didn't pay out $2,000. It's just a paper entry, and so um, that you like these expenses, especially ones that you don't pay any cash out for taxes. Now, as far as accounting is concerned, though, they will tell you that it is not a. Got plenty of room here. I guess I can. Depreciation is not a valuation. So we're not trying to see what the value of it is. Depreciation is an allocation of cost. So we're trying to, if we pay what, this is a bad example. If we pay 400,000 for this equipment, the question is, how much do we allocate every year? How much gets allocated every year for that equipment? So depreciation is not a valuation. So oftentimes you will have things that are very different. It's what they call an allocation of cost. And this can cause a problem too. I think I mentioned it at the beginning of class, but maybe not, or at the beginning of this chapter. So it's not a valuation, it's an allocation. Um, so where that becomes a problem is, you may have a building that you've had, let's say you bought a building in a long time ago, 1983, you bought a building and you paid the whopping sum of $50,000 for it. That building might be worth, it could be worth 2 million today, depending on where it is and all that kind of stuff. So you get this thing on your books, you paid 50,000 for it. You've been depreciating it every year, writing down the value of this building. Now, buildings don't last forever, and so writing it down. So you get this thing on your books maybe for, I don't know, 20,000 or something, and it's worth 2 million. And there's a big gap there. And that's part of the problem with the way we do depreciation. And by the way we do depreciation is nothing like econ people do depreciation. I can tell you how you'll get that in your finance classes. You should get the depreciation. Oh, I'll write it. The true depreciation according to econ people, approximation of it are the capital on the statement of cash flows. which we did earlier. Yeah, remember way back when we had the operating income. Oops, I mean, the operating cash flows. And we had investing. And we had financing cash flow. If you look under the investing cash flows, you'll have capital expenditures. And this is what oftentimes will be considered to be true to depreciation, or I should say approximate depreciation expense. So when you look at the formulas they give you in your finance class and they talk about capital expenditures off the statement of cash flows, you say, well, why is that in there? What an odd thing to stick in the middle of a, but that's because that is the approximation of what the real depreciation is. It's not 1-to-1, but it's pretty close. It's better. It's better than what we do in accounting generally. But yeah, it can be a problem, and you can have things on your books that, especially the things that have been around for a long time, the value is way off. It can be, especially for things like land and buildings. Um, you know, and when people buy it, they're not buying it for your book value. That building that you have on the books for 20,000, they can't buy it for 20,000. They're gonna pay 2 million for it or whatever. Um, you know, so it is a problem. And one of the problems too, by the way, is that a company might look very profitable because they have so few assets on the books. Another problem with that undervaluing the assets. You have something in your books for 20,000, through to 2 million. Maybe you're making $10,000 a year on. Okay, well, if you look at the book value, you say, wow, that's really profitable. This thing's on the books for 20,000, we're making 10,000, we're making 50% year after year after year on this thing. This book value is only 20. But if you look at it from, if it was worth 2 million, you're making $10,000 on it. Well, it looks terrible, right? I mean, you're whatever it would be, 5%. Yeah. Yeah, right. I don't know. But anyway, it'd be much less. You'd be very, so you have a company that's really being run inefficiently that looks like it's being run very efficiently because they have so few assets on them. So it is a problem. And international standards kind of address that, but US standards generally don't. Okay, we done. Oh, wait, we got one more to do. What am I doing here, man?
I
Uh,
don't think we could do the next one though either, because it's like the same thing, but Bronco receives 10,000.
yeah, but what we'll do is this. We can actually find the fair value of it. The only difference is instead of paying 10,000, they receive 10,000. So this will be minus the 10,000 that they gave us for it. What is it? 150, 140? So this is, yeah, we gave them a $150,000 piece of equipment, but then they gave us back 10,000. So the value of the equipment is really, so this is the fair value of it. So no, we can't, um, we still can't do the journal entry. This we can't do. Let's get rid of it. Can't do it. But the fair value of it would be 140,000. I'm mad at myself for missing that. Okay, well, okay, we did it all. Turn that. So, you're going to, what are you going to have on the test? Let's go through these here. You're definitely going to have something on the test for straight line, the regular depreciation, straight line double declining balance. And I think, and I'll give you one problem, probably be the straight line. So hold on a second, let me get a note going here. So the three depreciation, so what is this one? You're gonna have one like E11. I'm sorry, that's E1. And I'll clean this up in a second. And one like E1. Actually, take it back. It's going to be like E2. It'll be for 2 years. I'm not going to have you do all of them. All right. Let's see. We'll have one like E11.3, and I think we'll only do that for straight line. I don't think I'm doing one like that. And I'll give you one like E1014. One second, I will. Okay, so this is what's going to be on the exam. Yeah. So I'm going one like E11.2. That's going to be for like a couple years, 2 years worth. E11.3. That's for the interim dates one. That'll be straight line only. And then one like E1014. Yeah. And the reason for going to E1014, you might say, well, what about the ones that that's a trade-in one, or the ones for cash? The trade-in ones tend to be a little more tricky because the cash ones you don't have to figure out a fair value, but the E1014 you do. So that's what's going to be on your test. Questions? Okay. Again, what do I do here? So next week, No new material. So if you get the if you have all your tests and all that, you don't need to show up. You can show up, but you don't need to. But mostly for tutoring and assistance, getting people to get all their stuff in and all that kind of stuff is what we'll be doing there. I will be here, but again, and as long as there's people logged in, I'll be here. And but I'll send this out. The exam will be tomorrow, maybe tonight, but more likely tomorrow. And that's what's going to be on it. Any questions? Okay, well, great having you guys. And the evaluation for the course, actually for all your courses, it's in Blackboard. Let's see, maybe in Blackboard still. I am. Let me share my screen. In Blackboard, and I think this takes you to actually all of them. You'll see course evaluation. It doesn't let me evaluate the course. But if you click on course evaluation, I think all your course evaluations will be pulled up if you click on course evaluation. So if you're doing the course evaluation for this class or any other class, it'll be in there. And that's it. Any questions? Okay. Hey, 12 minutes early.
Can I talk to you?
Yeah.
Can I talk to you real quick?
All right. So if you want to stick around, stick around. If otherwise, I will hopefully see you in other classes.